The Arizona housing market is cracking at the edges. In Phoenix, the median sales price slipped to $449,500 in June 2025, down from $451,000 just a month earlier. The market indexed falls to 71, tipping firmly toward a buyer's market. Mortgage rates hover near 6.89%, squeezing affordability. Inventory swells. Nearly 25,000 homes now sit on the MLS in Phoenix. Buyers hold the strongest leverage in years. Sellers cut prices, add concessions, even walk away when listings expire. What once looked like unstoppable growth now looks like a slow slide. This isn't 2008, but the desert's shine is fading. The question is no longer if the market is correcting, it's how far Arizona falls before balance returns. For years, Phoenix was the textbook boom. Migration poured in, supply lagged, and sellers dictated every deal. Contingencies were waived, inspections skipped, and bidding wars drove offers of tens of thousands over asking. Now the pendulum swings back. Nearly 25,000 homes sit on the MLS in Phoenix, the highest in years. Inventory hasn't swelled because sales exploded. Instead, many listings have simply expired or been canceled as frustrated sellers pulled back. The shift is not momentum, it's exhaustion. June 2025 made the break obvious. The median Phoenix sales price slid from $451,000 in May to $449,500, a 0.3% decline. Small on paper, but it marks the first cracks in what was once an unshakable market. The Ravenscroft Market Index fell to 71, confirming the transition to a buyer's tilted landscape. Builders are the first to react. They roll out rate buydowns into the mid-3% range, offer closing cost credits, appliance upgrades, even landscaping packages. Incentives that didn't exist during the frenzy now signal a scramble to keep deals alive. Submarkets show just how uneven the correction is. Buckeye drops 8%, the steepest fall in the valley. Fountain Hills and Phoenix proper each slide 6%. Cave Creek flips into a buyer's market, while Avondale shifts from seller to balanced. As of June, just 2 cities remain sellers' markets, 7 are balanced, and 9 are now buyers' territory. Outlying metros Arizona City, Casa Grande, Gold Canyon lean even more heavily toward buyers. Behind the numbers, migration still fuels long-term demand. Phoenix has been one of the nation's fastest-growing destinations, but in 2025, inflows collide with affordability. Rates near 6.9% turn mortgage approvals into uphill battles. HOA dues and special assessments further push buyers away from attached housing, where condo and townhome success rates sink to 58%, the lowest since 2011. Manufactured homes fare worse, with fewer than half of those listings closing. The setup is clear. Inventory climbs, prices slip, builders dangle incentives, buyers gain patience, sellers lose control. What once looked like a desert boom now teeters on correction. Arizona's housing market is still moving, but who's doing the buying and who's not tells the story of a housing boom giving way to a controlled correction. Not every pressure point shows up in the sales price. Some are buried in the fine print: premiums, HOA dues, special assessments. These are the shadow costs that make Arizona's real estate feel like it's crashing, even as the numbers suggest only a correction. In Phoenix, buyers are walking away from attached housing. Why? Because recurring costs, HOA fees, and assessments are driving them out. Condo and townhome listings in May recorded just a 58% success rate, the lowest since 2011. Manufactured homes fared worse, with fewer than half of those listings closing. It's not just about price per square foot anymore, it's about the long-term bill. Builders see the strain and step in with incentives. In June, with mortgage rates near 6.89%, many offered buydowns to the mid-3% range, closing cost credits, and even perks like appliances and landscaping packages. Incentives that didn't exist during the frenzy now signal a scramble to keep deals alive. Insurance is the silent partner in this story. While the reports don't give specific dollar increases, the trend is clear. As wildfire zones expand and flood maps update, carriers raise premiums or exit altogether. For buyers, that means higher monthly obligations. For lenders, it means tougher approval standards. For sellers, it means another obstacle to overcome in negotiations. Layer these burdens on top of rising mortgage payments, and you get a market where affordability is crushed from multiple angles. Even when the median price dips to $449,500, the monthly reality doesn't improve. HOA dues can add hundreds per month. Insurance premiums tack on more. Suddenly, a discount home becomes unaffordable. The result is hesitation. Families that once rushed to close now pause. Investors who once snapped up condos step back. First-time buyers, already squeezed by rates, retreat completely. And when demand matters, inventory lingers. Phoenix now sits with nearly 25,000 active MLS listings, a number that underlines how supply overwhelms demand. This hidden cost shock doesn't generate headlines the way median prices do, but it reshapes behavior just as dramatically. Sellers who once assumed quick deals now offer concessions simply to offset buyers' insurance or HOA concerns. Builders slash rates artificially by offering buy-downs into the mid-3% range. It's all smoke and mirrors to keep buyers in the game.
But for the average household, the math doesn't add up. Wages haven't doubled to keep pace with doubled borrowing costs. Families who would have qualified easily 2 years ago now fall outside debt-to-income ratios. Some leave the market entirely, adding to the 3.5% decline in active listings caused by cancellations and expirations. The net effect is a paradox. Prices appear stable, but ownership is less affordable than at any time in the past decade. Incomes haven't caught up, interest rates have locked in, hidden costs layer on top. Even small discounts in home values don't reverse the squeeze. This is why headlines about correction, not crash, feel hollow for buyers on the ground. When your monthly outlay is nearly $1,000 higher than it would have been in 2021, it doesn't matter if the median price dipped by just $1,500. Affordability is the real crash, and it's unfolding now. Liquidity is the bloodstream of real estate. Listings convert to contracts, contracts close, money moves. In Phoenix, that flow is slowing. The numbers tell the story. Active listings dropped by 3.5%, not because homes sold, but because sellers gave up. Their listings expired or were canceled. Frustration is rising. Sellers who once expected multiple offers now face silence. The median price dip to $449,500 didn't jumpstart demand. Instead, more homes sit, waiting. Phoenix MLS data shows nearly 25,000 properties on the market. That's supply without velocity. Buyer psychology compounds the stall. In 2021, competition forced frantic closings. Today, buyers sense leverage. They negotiate harder, walk away more often, and hold out for concessions. In June, builders scrambled with buy-downs to mid-3% mortgage rates and closing cost credits. Without these perks, deals collapse. Segment by segment, liquidity thins. Condos and townhomes, only 58% of listings closed in May, the weakest since 2011. Manufactured homes fared worse, fewer than half sold. These aren't marginal corners of the market, they're clear signs of a slowdown. Even sellers who stick it out are cutting prices. Brokers report reductions of 10% or more just to draw offers. But discounts don't guarantee liquidity. With 30-year mortgages at 6.89%, affordability remains too tight. The result is a jammed pipeline. More homes listed, fewer homes sold, cancellations rise, expired listings grow, transactions stall. The market isn't frozen, but it's sticky, and stickiness bleeds confidence. For agents, this correction feels like quicksand. They see inventory climb, buyers hesitate, sellers retreat, deals take longer, closings fall through. Every extra day a home sits on MLS adds to carrying costs, and every failed sale becomes another data point that erodes trust. Liquidity doesn't collapse overnight like in 2008. It erodes transaction by transaction until the system feels clogged. That's exactly where Phoenix stands now. The numbers prove it. Small price declines, huge backlogs, and an exhausted group of buyers and sellers staring at each other across a widening gap. Corrections unfold slowly until they don't. In Arizona, the risk isn't just gradual cooling, it's the sudden freeze. One trigger is the Fed. Buyers and sellers wait for every rate announcement. As of mid-2025, 30-year mortgage rates hover at 6.89%. A hike keeps affordability crushed. A cut sparks brief momentum. Each decision freezes the market until the outcome is known. Deals stall in escrow. Buyers hesitate to lock loans. Sellers delay listing. Another shot comes from global stage. Tariff disputes ripple through consumer confidence. Stock market swings, amplified by unpredictable policies, rattle households. Realtors in Phoenix report that volatility itself, not just the numbers, is slowing decisions. People wonder if their down payment will be worth less tomorrow. Some pull out entirely. Luxury is not immune. High-end buyers usually feel less rate sensitive, yet even here, hesitation shows.
Realtors note that seasonal slowdowns in Phoenix's luxury segment now blend with broader uncertainty. Properties linger while sellers wait for more stable conditions. Environmental and local triggers carry their own risks. Wildfire zones expand. Flood map updates alter insurance requirements. Carriers adjust premiums or exit, creating gaps in coverage. For buyers, no policy means no loan. Transactions collapse overnight. Not because the home changed, but because the risk map did. These moments create instant paralysis. Listings sit, buyers retreat, lenders tighten. Sellers pull back. What was momentum one week becomes silence the next. Phoenix has already shown its vulnerability. Active listings fell 3.5% recently, not from sales, but from cancellations and expirations. Imagine that amplified by a Fed surprise or an insurance withdrawal. The liquidity crunch described earlier would harden into a freeze. This is the fragility of Arizona's real estate today. Prices don't need to crash 20% to feel like collapse. All it takes is one shock, a rate hike, a tariff deadline, and natural hazard warning. And deals already hanging by a thread stop cold. Markets don't shift on prices alone. They move at the friction points, where builders, regulators, and local governments collide. Builders are on the front line. With 30-year mortgage rates stuck near 6.89%, they know buyers can't carry the full load. Their response? Heavy incentives. Rate buydowns to the mid-3% range, closing cost credits, appliance packages, even landscaping perks. These aren't extras, they're lifelines. Without them, sales pipelines stall. Sellers, meanwhile, recalibrate. Phoenix brokers report price reductions of 10% or more to match the new reality. What once passed as aspirational pricing has shifted towards survival pricing. Those who resist often see their listings expire or get canceled altogether. Policy overlays complicate every move. Nationally, the Fed's interest rate strategy sets the ceiling. Locally, zoning boards and city councils determine how much new supply comes online. In Phoenix, nearly 25,000 MLS listings already sit unsold. Approving more housing may sound like a fix, but in a cooling market, added supply can deepen the imbalance. Regulators add another layer. As insurance costs creep up, lenders enforce stricter underwriting. That means more deals collapse at the financing stage. For attached housing, where HOA dues and assessments already push buyers away, the extra scrutiny makes liquidity even thinner. Yet the rhetoric remains optimistic. Realtors cite long-term fundamentals and population growth to argue stability. But optimism doesn't pay monthly bills. Households under pressure need policy clarity on rates, on taxes, on insurance, before they commit. The result is a tug of war. Builders spend to keep deals alive. Sellers cut deeper to stay competitive. Regulators enforce caution. And buyers, caught in the middle, wait. Policy may not crash the market outright, but it shapes who wins and who folds during the correction. Arizona's correction is not just numbers. It's a turf battle, where every concession, every policy, and every rate decision decides which side of the deal bends first. Arizona's real estate story isn't uniform. It's a ladder of submarkets, each showing different stress levels. Some slip fastest, others hold the line. Start with Buckeye. June data shows an 8% price drop, the steepest decline in the valley. A metro once fueled by new construction and commuter inflows now finds itself on the front end of the correction. Next, Fountain Hills and Phoenix proper, both sliding 6% year over year. These aren't fringe communities, they're core demand centers. When central metros bend, the ripple extends outward. Cave Creek is another turning point. Once a seller's market, it has crossed into buyer territory. Avondale made a similar move, shifting from a seller's market to a balanced stance. These transitions matter. They signal that leverage has flipped in communities that once favored sellers. Zoom out further. As of June, 2 cities remain seller's market, 7 are balanced, and 9 now lean buyers. That's a full map of momentum loss. Outlying areas, Arizona City, Casa Grande, Gold Canyon, tilt even harder toward buyers. The further from the core, the steeper the swing. Meanwhile, inventory keeps building. Phoenix's MLS tracks nearly 25,000 active listings. Supply alone isn't a crash, but combined with rate pressure, it dilutes urgency everywhere. Homes sit longer, concessions multiply, and yet resilience exists. Luxury enclaves, though slower in summer, continue to transact. Long-term fundamentals, population growth, job creation support the argument that correction, not collapse, is the right word. Still, submarkets don't correct evenly. The latter is clear. Most stressed, Buckeye, minus 8%, Fountain Hills and Phoenix, minus 6%, shifting, Cave Creek, buyer's market, Avondale, balanced, buyer-heavy outliers, Arizona City, Casa Grande, Gold Canyon, relative resilience, luxury enclaves and select neighborhoods where cash buyers dominate. For buyers, this latter is a map of opportunity. For sellers, it's a warning. Arizona's market is not one uniform correction. It's a patchwork where local conditions decide whether you're staring at resilience or at freefall. Arizona's housing market isn't collapsing like 2008, but for buyers and sellers on the ground, it feels like a crash. Affordability is crushed, liquidity is thin, and submarkets are breaking unevenly. The key stats tell the story. Median Phoenix price, $449,500 in June, down from $451,000 a month earlier. Market index at 71, signaling a buyer's market. 30-year mortgage rates at 6.89%, double the payments compared to pandemic lows. Buckeye, minus 8%, Fountain Hills and Phoenix, minus 6%. Condos and townhomes, only 58% of listings closed, the weakest since 2011. Active MLS listings nearly 25,000 in Phoenix, many sitting unsold. Listings down 3.5%, not from sales, but from cancellations and expirations. For buyers, this means leverage, more inventory, deeper concessions, and room to negotiate. For sellers, it means reality checks, price reductions, concessions, or withdrawals. For investors, it means caution. Uneven submarkets and rising holding costs demand sharper strategy. The 6 to 12-month outlook? More corrections. Builders will keep buying down rates to keep sales alive. Sellers will keep trimming asking prices, and buyers will keep waiting for clarity, testing how far the market bends. Arizona is not in free fall, it's reset. But for households squeezed by higher payments and hidden costs, that reset feels like the crash they feared.